Okay, so you think Uber makes its money from rides. It's a fair thing to believe. The company is named after the thing it does. You open the app, a car appears, you pay, the driver takes some, Uber takes some, and the difference is the business. In 2024, 11.3 billion trips ran through that system. Customers paid roughly $163 billion into it. Uber kept about $2.8 billion in profit from actually operating the business. 6 cents on every dollar of revenue, under 2 cents on every dollar that crossed the platform. That is not what a transport company's accounts look like. That's what a landlord's accounts look like. Enormous sums moving through, a very thin slice sticking to the sides. And yes, the number everyone quoted that year was $9.9 billion, not $2.8 billion. About $6.4 billion of the difference came from a single accounting entry, which we'll take apart in a moment. It's legitimate. It also happens exactly once, and it isn't a business. So hold the real figure in your head. 11 billion trips, 171 million monthly riders, 8.8 million people driving and delivering, one of the largest coordinated movements of human beings on the planet, and it clears less than 2 cents on the dollar. Millions of cars in the system, and Uber owns almost none of them. That isn't a quirk of the model. That is the model, which leaves the question this whole thing turns on. If moving 11 billion people is barely profitable, then what is Uber actually selling? It isn't the ride. The ride is the entry fee. Uber doesn't work like a transport company. It works like a shopping mall, one that charges every tenant a cut of their sales, sells a membership card at the door, and has recently worked out that it can rent out the billboards inside. 3 revenue engines. The rest of this is how each one runs. First, that accounting entry, because it teaches you how to read everything that follows. Uber lost money for a decade. Under the tax rules, past losses can be used to reduce future tax bills, but only if your auditors believe you'll earn enough, for long enough to actually use them. For years, they didn't believe it, so the losses sat on the books valued at nothing. In 2024, they changed their minds. That change of mind was recorded as $6.4 billion of income. Nothing was sold. Nobody was moved. An opinion about the future was converted into a number on this year's income statement. Every figure you're about to hear has that quality somewhere in it, which is why the useful question is never, how much did they earn, but earn from what? Because Uber isn't one business, it's 5, stacked under one logo, and they behave nothing alike. Rides is the one you know. In 2024, about $81.7 billion of bookings, $25.1 billion of revenue, roughly $6.2 billion of segment profit, measured Uber's preferred way before interest, tax, and the accounting charge for wear on equipment. That's a generous way to count. Hold on to that. There's a joke buried in it that only lands later. Delivery is where the mental model needs its first correction. Uber Eats, groceries, convenience. About $74.7 billion of bookings, nearly as much money flowing through as the entire ride business, and out the other end, $13.7 billion of revenue and roughly $2.4 billion of segment profit. Almost the same volume, well under half the profit. The biggest part of a business is very often not the most valuable part. Delivery is the textbook case, and the reason is embarrassingly physical. Somebody still has to carry a paper bag up 3 flights of stairs while the food goes cold. Every extra minute of that is cost and none of it scales. Freight is the third, and I'm going to tell you almost nothing about it right now. Uber applied its matching engine to trucking. On paper, it should have worked better than anything else the company has ever done. It became the most expensive mistake in its history, and it exposes the exact limit of the entire model. That one gets a full autopsy later. The fourth barely existed 5 years ago, and it's the one that should have your attention. Advertising. Sponsored listings when you scroll restaurants, promoted merchants, brand placements. Uber said this crossed $1 billion a year in run rate around the end of 2023 and kept compounding hard. Against $44 billion of total revenue that reads like a rounding error until you notice what it costs to deliver. No driver, no fuel, no insurance, no bag of food cooling in a stairwell. Almost the entire dollar survives the trip down to profit, which is a sentence you cannot write about any other part of this company. And the fifth business is one Uber never meant to be in at all. For years, some of the most valuable assets on its balance sheet were shares in foreign rivals it had failed to beat. Didi in China, Grab in Southeast Asia, Zomato in India, Aurora in self-driving. A transport company quietly operating a venture fund. When those holdings fell in 2022, they produced roughly $7 billion of losses, which is most of why the company reported a $9.1 billion net loss that year without anything going wrong in the cars. 5 businesses, 1 brand. And the one throwing off the cleanest money is the one nobody thinks of as a business at all. To see how the machine actually works, drop the transport framing completely and look at how a mall makes money. A mall doesn't sell shoes, no inventory, no shoe staff, no risk that this season's stock doesn't move. It owns the floor, decides who gets a lease, and charges each shop a base rent plus a slice of their sales. That second part is a genuine arrangement in commercial property, and it contains the whole trick. The landlord's income rises with the tenant's revenue and never, ever with the tenant's costs. If the shop has a bad month, the shop absorbs it. The mall's only real job is keeping enough shoppers walking past enough shops that neither side can afford to leave. Uber's version of that slice is called the take rate, the share of what you pay that Uber records as its own revenue instead of passing on. In 2024, the take rate on rides ran around 30%, on delivery closer to 18 or 19%. Those aren't perfectly comparable. An accounting change in markets like the UK flatters the ride figure. The direction isn't in doubt. Reported figures put Uber's effective cut in the low 20s around 2016. It has climbed almost every year since, 30 cents of every ride dollar. Now, why does anybody accept that? A driver could leave tomorrow. A rider could open a different app in 4 seconds. Nothing physically stops either of them. The answer is a word that runs this entire industry: liquidity. In a marketplace, liquidity means density. Enough drivers near you that the wait is 3 minutes instead of 11, and enough riders near them that the next fare arrives before the boredom does. Liquidity is the moat. You can't build it with clever engineering because the engineering isn't hard. A competent team can clone the app in months. You can only buy it with time or with money. Uber spent about a decade buying it with money. This is the point where ordinary business logic stops applying. From roughly 2012 to 2019, Uber deliberately sold rides for less than they cost to provide, and investors funded the gap. The 2019 net loss alone was around $8.5 billion. That same year, the platform ran somewhere near 7 billion trips. Divide it however you like, the company was paying, out of other people's pockets, for the privilege of moving you across town. Over its life, it raised well north of $20 billion and accumulated tens of billions in losses before finally posting a full year of operating profit in 2023 of about $1.1 billion. Nobody survives that unless the losses are buying something specific. These bought 2 things, and only one of them was density. The other was a permanent reset of what an entire generation believes a private car ride should cost. Then came the change that rewired the physics of the whole system: upfront pricing. Originally, your fare and the driver's pay were 2 ends of one number. 1 meter, 1 total, Uber's percentage off the top. Under upfront pricing, Uber quotes you a price built from distance, time, and how badly its model thinks you want that car, and separately calculates what to offer the driver. The 2 numbers are no longer mechanically connected. Uber's real cut on any individual trip can sit far above or far below its published average, and neither you nor the driver can see the other side's figure. That is not an interface tweak. That is the landlord acquiring the power to set the shop's prices and the shop's costs independently, while keeping each of them blind to the other's receipt. No taxi meter ever had that. No mall tenant would ever sign it. So follow the sequence, because this is the chain that made everything else possible. Cheap rides bought density. Density made the app the default. The default killed the alternative. New York taxi medallions that traded above $1.3 million in 2013 were worth a fraction of that within 5 years. That collapse wasn't Uber alone. Later, reporting documented a lending bubble already inflating before Uber arrived. But the effect was the same. The thing you would have switched to stopped existing, and once there was nothing to switch to, the cut could move. Low 20s in 2016, around 30% now. Nobody voted on that. Nobody was asked. The subsidy that felt like generosity was the purchase price of the right to raise the rent. Now the part that makes the margins possible in the first place, the balance sheet Uber doesn't have. The largest transport network on Earth owns almost no vehicles. There are millions of cars in the system, and every one of them, purchase price, financing, insurance excess, tires, brakes, transmissions, and above all, the steady loss of value, sits on the personal balance sheet of an individual driver. That last one is the quiet killer because it never arrives as a bill. A car sheds value with every mile whether you notice or not, and a rideshare car accumulates miles at several times the rate of a private one. You feel it exactly once, years later, when you try to sell it and the number is lower than the number in your head. The cost is completely real, completely predictable, and completely absent from Uber's accounts. Which is where the joke I promised finally lands. Remember that generous way of measuring segment profit before the accounting charge for wear on equipment? Uber barely needs the exemption. There's almost nothing on its books to wear out. The wear is real, it's happening right now, at scale, across millions of vehicles. It's just invoiced to somebody else. Compare that to an airline, which has to book the declining value of its own aircraft as a cost every quarter. In public, forever. Uber operates a fleet without owning a fleet. The capital belongs to other people, and so does the deterioration. There is one bill the mall can't hand to a tenant, and it's insurance. Covering commercial driving is one of the largest costs Uber can't push on to anyone else. And in the United States, it has been rising. Larger claims, more litigation, bigger reserves required. Uber has flagged this repeatedly in its filings and has taken charges to top up reserves on older claims. It's the one place where the physical world reaches back through the app and bills the company directly for the fact that cars sometimes hit things. Everything else is engineering, and the engineering has one goal: remove every visible price signal from the moment of decision. The old taxi meter was a hostile little machine ticking upward in front of your face, keeping you conscious of the cost for the entire journey. Upfront pricing kills the meter. You approve one number, once standing on a pavement in the rain, wanting very much to be indoors. Payment is invisible. No wallet, no tip arithmetic under social pressure, no moment of settlement where you hand something over and feel it leave. Friction is the enemy of frequency, and every decision point removed raises how often you ride without ever raising your sense of what you're spending. The driver's screen is built on precisely the inverted logic. Friction added on purpose. Quests, streaks, surge maps, consecutive trip bonuses, all shaped to keep someone online through the unpaid stretches of a shift. And there are unpaid stretches. The industry term is utilization, the share of your online hours actually spent carrying a passenger or a package. The remainder is cruising, waiting, repositioning. Time you spend burning fuel and mileage for nothing. Online 8 hours carrying someone for 5, and those other 3 hours still cost you petrol, still cost you the car, and pay you 0. Uber's published driver earnings are typically measured on engaged time and stated before vehicle costs. Independent estimates of true net hourly pay vary enormously depending on how you count depreciation and idle time. And it remains one of the genuinely contested numbers in this industry. What nobody contests is who absorbs the empty hours. The mall found a way to charge rent on floor space the tenants brought with them. But all of that, the cut, the density, the invisible depreciation, has a ceiling. The take rate is capped by what a driver will tolerate and what you'll pay before you walk. Uber has been pressing against that ceiling for years. The part with no ceiling is what the app learned about you on the way. Uber knows where 171 million people go. It knows when they leave, how often, which nights they don't come home, what they order when they get in, and what they order when they're drunk at 1 in the morning. It spent a decade and tens of billions of dollars building the most detailed map of human movement and appetite ever assembled. And it built it while everybody, including most of its own investors, believed it was in the taxi business. That map is what advertising is sold against. When a restaurant pays for a sponsored slot in your Eats feed, it isn't buying screen space. It's buying access to somebody the platform already knows is hungry, already knows is nearby, and already has payment details for. That is close to the most valuable advertising position that exists. And it's why a business measured in low billions matters more to Uber's future than a segment measured in tens of billions. The membership card works the same trick from the other side. Uber One passed 30 million members, and members reportedly account for around a third of all bookings, while spending materially more than everyone else. A subscription doesn't just collect a fee, it converts a decision into a default. You already paid, so you stop comparing, and the app you stop comparing is the app whose data gets richer, which produces the correction that reorganizes everything. In the ride business, you're the customer. In the advertising business, you are not the customer. You're the inventory. Twice this model has hit something it couldn't root around. Both times the lesson was the same, and both times it cost billions to learn. The first is China. Uber went in around 2014 with a strategy that had worked everywhere. Subsidize hard, buy density, wait for the other side to run out of cash. The other side was Didi Chuxing. Same investor appetite, far better local standing. What followed was a war of attrition fought entirely with other people's money. Travis Kalanick told investors in early 2016 that Uber was losing over $1 billion a year there. Both companies were paying driver bonuses that exceeded the fares themselves. By multiple contemporaneous reports, some drivers were running fake trips purely to farm the subsidies. From outside, the peak looked like triumph, enormous volume, enormous market share. But the volume existed only because both sides were pricing below cost simultaneously. Remove the subsidy and most of it evaporates. The turning point was arithmetic. Whoever could raise more for longer would take the market, and it was never going to be the foreign entrant. In August 2016, Uber handed its China operation to Didi in exchange for a stake reported at roughly a fifth of the company. Presented as a win, no more billion-dollar burn, a valuable shareholding instead of a war. The shareholding didn't hold. Didi listed in New York on June 30th, 2021, raising about $4.4 billion. Within days, Chinese regulators pulled its app from domestic stores over data security concerns. And by June 2022, it had left the exchange entirely. The trophy taken in surrender collapsed in value, and that write-down sits inside the roughly $7 billion of investment losses behind the 2022 net loss. What it proves goes straight back to the mall. The model requires that you own the only mall in town. Where a rival can buy liquidity exactly as hard as you can, there is no default, no captive tenant, and therefore no toll. Uber didn't lose China on product. It lost because you cannot charge rent on a floor that two people are giving away. The second episode is freight, and it's the more instructive failure. In 2021, Uber agreed to buy Transplace, a logistics management company, for about $2.25 billion closing that November. The logic was clean. Uber matches supply and demand. Trucking is a matching problem, worth vastly more per transaction than a ride to the airport. And freight rates at that moment were at historic highs. Capacity scarce, prices extraordinary, the numbers spectacular. The warning sign was that those rates were a pandemic artifact. As supply chains normalized through 2022, capacity came flooding back and prices fell hard. A slump the trucking industry itself called a freight recession, and one that dragged on for years. Uber Freight's revenue stayed large, because a freight broker books the entire value of a shipment as its own revenue, which flatters the top line and tells you nothing. What mattered was the gap between what the shipper paid and the carrier received, and that gap squeezed toward nothing. In the third quarter of 2023, Uber wrote down roughly $721 million of the value it had assigned to the business. The accounting method of admitting you paid a cycle peak price for a cyclical asset. By 2024, freight was converting $5.1 billion of revenue into approximately zero profit. The lesson is sharper than they overpaid. Uber's founding insight that matching is valuable is correct. But matching is only worth anything where the participants are fragmented, inexperienced, and short on alternatives. An individual driver with a car loan fits that description exactly. A professional freight broker with relationships built over decades and margins negotiated to the cent does not. Take the same machine into a market that already knows what it's worth, and there is simply no 30% to take. So run both cases honestly. The optimistic one is what the market is currently paying for, and it isn't unreasonable. Uber generated roughly $6.9 billion of free cash flow in 2024 against $2.8 billion of operating profit. The gap is largely timing and share-based pay, but the cash is real. Advertising compounds off a small base at very high margin. Membership converts choice into habit. Every extra ad dollar and every subscription fee lands on infrastructure that has already been paid for by investors a decade ago. In that version, the profit engine quietly migrates away from moving people toward monetizing the habit of opening the app. And the transport business becomes what it probably always was, a very expensive way to acquire a user. The realistic negative case sits in the same filings. Strip out the one-off tax entry and the swings on foreign shareholdings, and the operating business earned about $2.8 billion. Roughly 6% of revenue, under 2% of what actually flowed across the platform. Insurance keeps climbing. Whether drivers are contractors or employees remains legally unsettled across multiple jurisdictions, and any ruling that flips it rewrites the cost structure overnight. Self-driving vehicles, which Uber now partners on rather than builds, could remove the driver cost entirely, or hand the network to whoever ends up owning the cars, which would be the same trick played on Uber that Uber played on the taxi trade. Collapse the whole thing into one sentence. Uber charges rent on the largest fleet of assets it doesn't own, worked by people whose costs it doesn't book, sold to a customer base it now bills for membership and rents out to advertisers. That's the same structure Booking Holdings runs on hotel rooms it doesn't own, and Visa runs on transactions it doesn't originate. Intermediaries that never touch the inventory and never carry the risk. The difference is a matter of degree and durability. Visa's toll is a fraction of a percent on something nobody can replace. Uber's is 30% on something a decade of subsidized rides made feel irreplaceable. And the part that never shows up in the pitch is that every one of those cars still belongs to the person driving it, still losing value with every mile, still financed, insured, and repaired on somebody else's account, in somebody else's evening, at somebody else's risk. If you've driven for one of these platforms, you already know which side of that arithmetic you're on, and I'd genuinely like to read that in the comments. Because the mall never got rich selling shoes. It got rich giving shoes away until the shops across the street closed, then charging rent on floor space it never had to build, to tenants who arrived carrying their own floor. It never owned a single pair. It just made sure it owns the door.